Hey, welcome to Sullivan Smart Sense. I'm Heather Sullivan. Today we are going to talk about a topic that is going to be weighing on a lot of people, and that is because federal student loan payments are going to be resuming very soon after about 3.5 years of a break. And some of you may have even forgotten that you have student loan payments that are going to be coming due. And there's been a lot of changes, hopefully that are changes that will help you, because we know so many people are struggling financially right now just to make ends meet after all the inflation we've had. It's kind of a gulp, to think about having to make a big monthly payment on top of everything else. So we're going to talk about changes to the repayment plans and the options. We'll talk about changes to the forgiveness plans and how that's going now. We'll talk about changes to the loan servicers. And I've got one of my favorite experts who's going to be joining us to help us break it all down. Please join me in welcoming Jason DiLorenzo with Ben Elevate. Thanks so much for being with us.
Hey, Heather, how you doing? Thanks for having me.
You bet. Well, first, just one of the reasons I always like to interview you is because you've really kind of dedicated your career to helping people navigate what has kind of been a mess in student loans.
Indeed.
So just tell me a little bit about your background and what you do.
I started in the student loan industry in 2010, and that was a pretty a marker year for student loans, because that was when the Obama administration nationalized federal student loans. So if you think about July 1st, 2010, a lot of student loan changes happen in July of each year. We've got some coming in next July, and we just had some this past July 1st. The nationalization of student loans means that everyone's lender is the U.S. Department of Education. So if direct federal student loans mean Department of Education loans. That started in July of 2010, and it exists today. Nothing has changed in terms of all federal student loans from accredited schools come from the U.S. Department of Education. Before that, you had these other players in the marketplace: Sallie Mae, Citibank, Discover, Wells Fargo, private lenders that participated in federal lending. So when the government nationalized student loans, they also expanded repayment options. This became very complicated. And I was part of a team that was working with medical schools to do exit counseling at medical schools around the country. And so I did that for almost 10 years, and then pivoted to working with employers here more recently. What has happened is that a lot of the education we were doing in medical schools 10, 12 years ago is now necessary, as this complex and evolving marketplace involves, medical schools have always lent a lot of money to borrowers, but now you've got, teachers in public schools with master's degrees and $200,000 of student loan debt. This problem is 40 million people deep almost.
Oh, it's huge. Yeah.
Yeah. And so we've expanded that type of really prescriptive, not to use a term for doctors, education across to all borrowers over the years.
Well, it's wonderful to have you with us. I always appreciate your expertise. And we want to invite our viewers. We are live today, and I know a lot of you have questions. So any question you have about student loans, just write them below. We're here to answer your questions. I got one little note from a viewer already, Mills, who says, I need help with this. So Mills, we're here to help you.
Let's see, see if we can help you out, Mills.
Yeah. Keep those questions coming. Let us know what we can help you with. Let's first just start talking about some of the changes, and to dive right in, let's talk about the repayment plan changes. There's been a number of changes, and it looks like there are options that can really help people this time around.
Yes, the repayment plan change that I'm speaking the most about with borrowers is this new SAVE plan, Saving on a Valuable Education. The acronym for it is SAVE. It's actually just an update or upgrade of the existing revised pay-as-you-earn plan. There are a number of income-driven repayment plans that are available to borrowers today. If you think about someone that has some lump sum of federal student loan debt, $50,000, $150,000. There are all levels of debt out there. A lot of times coming out of school or any time in your career, particularly during times of economic struggle, a 10-year repayment term just doesn't make economic sense, or it's truly untenable. Income-driven repayment plans exist to limit your monthly payments on your student loans, no matter what your debt is, to some affordable amount of monthly payment for you. And this new SAVE plan is by far the most generous of any of these income-driven repayment plans, and eliminates also a lot of the hurdles that existed with trying to choose between this menu of different income-driven repayment plans that has existed for now for over 2 decades. If we talk about the oldest plan, what this SAVE plan allows you to do is make the smallest monthly payment required in an income-driven plan possible. These payments are based on your discretionary income, and the multiple on which they calculate discretionary income is the highest in the SAVE plan. What that means in layman's terms is the lowest required monthly payment. Then in addition to that, whether you're married or you're single, if you have a working spouse who does not have student loan debt, great, you've got more household income. But filing your taxes married and separately versus jointly has been a struggle to navigate for a lot of borrowers who are married and trying to get the lowest possible payment. SAVE allows you to cut it either way. With the old revised pay-as-you-earn plan, you weren't allowed, you could file your taxes married and separately, but they were still going to ask for your household income. Now, if you file separately, they're just going to look at your tax return. So to give some context to this, because there's a lot of disappointment around the fact that the Supreme Court ruled against blanket loan cancellation, and that really does look like the measure that's coming down with even bipartisan support to not do blanket loan cancellation, but these individual and targeted forgivenesses have gotten much more generous. The SAVE plan, as an example, has a 20 or 25-year loan forgiveness trajectory, depending on when you took out your loans. And single borrowers who are earning any less than around $30,000 a year still aren't going to have a payment, even coming out of CARES. The discretionary income formula doesn't start till above $30,000 in income for single folks. For families, for example, a household of 3, you're talking about not really having a payment. Your payments are zero with any household income below $60,000 a year. So a lot of folks, if they use SAVE, might still not have a repayment, a payment obligation come September 1st if they're using this SAVE plan. So when you ask about the changes in repayment plans, that is by far the most substantial and most impactful one that we've seen.
Yeah, and that was, the president came out and started talking about that, I think, when they knew that the Supreme Court was going to block the effort to do kind of the blanket forgiveness of 10 to 20,000. This was the backup. And you're right, it really should be able to help a lot of people.
Absolutely.
Let's talk a little bit about loan forgiveness, because when you and I first started doing interviews together, it was a giant mess, and we had all kinds of people that were not able they were applying for it, getting denied for it, and yet they were in the military, they were working as teachers and all these public service. And then they made changes. So first, just talk a little bit about the changes and how's it going now? Is it going better?
Yes. Well, so the first one I'll talk about is the Public Service Loan Forgiveness Program. And this is really relevant. I don't think a lot of people know how broad this program is. The PSLF program there are 35 million jobs in the United States that qualify for PSLF, Public Service Loan Forgiveness. That's working full-time for any federal, state, or local government or agency, or if you work directly for any 501c3 nonprofit is the broadest definition of it. This program did have a lot of issues. It was created by Congress back in 2007 and is actually still today in borrower promissory notes. So I'm sure you've all read your promissory notes cover to cover. But this is available. What the issue with pursuing loan forgiveness, something that we talked about at the beginning of this discussion, was before the nationalization of student loans in 2010, and PSLF came out in 2007. The requirements for PSLF were you had to have Department of Education direct loans. And you also had to use an income-driven repayment plans. Well, we didn't start teaching income-driven repayment plans in medical schools till 2011. And it really probably didn't hit critical mass until that year or the year after. A lot of borrowers didn't know how to use these, and servicers were sneakily or self-servingly not telling people that they could consolidate their loans, and they didn't really understand it. The front lines people you're talking to at a loan servicer didn't understand the complexities of an income-driven repayment plan. And so you had most people that were working in public service not meeting the requirements because they weren't getting the advice to consolidate and use an income-driven repayment plan. That's been fixed. Today, most schools are or should be teaching the income-driven repayment plans. If not, let me know if your school's not. And then the direct loans have existed, of course, since July of 2010. So those are automatically, without consolidation, eligible for PSLF. In October of 2021, the Biden administration announced a retroactive fix to PSLF called the limited waiver. This has since been, the limited waiver technically expired last October, at the end of last October, but the IDR, income driven repayment plan account adjustment, kind of picked up where the PSLF waiver left off. And that, what they're essentially doing with this, I don't want to get it too complicated here in this discussion. I'm happy to answer questions. Effectively, if you weren't eligible for loan forgiveness through an income-driven repayment plan or PSLF because you were in a long-term forbearance or the wrong kind of repayment plan, i.e. not an income-driven plan, you can still apply for retroactive credit towards PSLF. So that 10 years, which is required for PSLF, and the income-driven repayment plans also have loan forgiveness between 20 and 25 years available. You can get retroactive credit now for your time spent in the wrong kind of repayment plan or the wrong kind of loan. The IDR account adjustment, they're doing automatically. You just have to wait. Some of you watching may have already gotten notification that you're having so many years counted towards loan forgiveness in an income-driven repayment plan. PSLF candidates need to do the PSLF form process so that the government will then go back and look back at that retroactive period to see that you were in a repayment or a forbearance. So suffice it to say, before that waiver for PSLF, only about 16,000 people had gotten their loans forgiven through PSLF. Not a high number when you had over 1 million participants. Yeah. Now, today, it's just under 700,000 borrowers as of the last count I saw, and almost $50 billion just in PSLF. Additionally, another 800,000 borrowers have just been notified. That's why I'm saying some of your audience might have just received this info, and maybe they're not tuning in if they don't have student loan debt. But the IDR account adjustment is still in the process of being counted. You can still consolidate those old pre-2010 loans to direct loans and get retroactive credit for time spent towards loan forgiveness. Particularly, you want to do that if you're working in public service. And that, the tune of the IDR account adjustment on top of PSLF is another about $39 billion. So that's just the income-driven plans and PSLF forgiveness. Then you've also got targeted loan forgiveness, such as what's called borrower defense to repayment. That's where these for-profit schools maybe had bigger sales teams than they had teachers, and there's been loan forgiveness available to those who have been essentially, they termed, defrauded by schools' sales processes and had federal outstanding student loan debt, but had been sort of defrauded through this borrower defense to repayment. So that's been a meaningful amount of loan forgiveness that's still ongoing.
Okay. We want to again invite our viewers to ask questions. Just write your questions below. We're here to answer your questions while we're having this live discussion. Mills, he's asked me where he can apply for help, and we'll talk about that. And he's also asked this: I want to go back to school, but my past grant and loans won't let me without paying out of pocket. I don't know if that's something specifically in your wheelhouse, but any advice for him?
So if you're going to an accredited school, I would presumably you'd be able to still take out federal student loans. There's usually limited amount of underwriting that happens for getting into an accredited school program. I don't know if you're talking about going to a private school or having potentially to take out private loans. Certainly a past grant would be not money that you're owed. A grant isn't a loan. So things such as the Pell Grants that were TSU, that presumably that's an accredited institution. So that I would assume that the financial aid office can assist you with taking out loans in school from an accredited university.
Okay. Thanks very much for the question, Mills. And anyone else who has any questions,
thanks,
please just chime in. Let's talk. The
Absolutely.
loan servicers changed
Yeah.
during this pause.
Yeah.
And so some people may not know that their loan servicer changed. Can you talk about what happened there and how people can go
Ab-
ahead and find that
Absolutely.
information?
Yeah. So one bit of advice here, in case we don't, I'll just get this out of the way now for all of you who are preparing to go into repayment. If you haven't, if you've not looked into your student loans for 3.5 years, or you've moved, or anything has changed with respect to your surname, any status, you want to make sure that your loan servicer has your updated information so that they can communicate with you. So updated email, updated address, updated family information, references, all of that. That's important. And yes, roughly of the over 40 million borrowers, about 30 million have experienced a loan servicer change over the past few years. New servicers have come into the fold, and others have folded their hands in servicing federal student loans. And so make sure that your information is updated with your loan servicer. If you're not sure who your loan servicer is, you can go to studentaid.gov and make any required changes to your student loan plan that you need to make. So studentaid.gov houses, because again, you have direct federal student loans are housed lent by the Department of Education. You have access through studentaid.gov to look at your loan profile and make any changes that you need to, such as consolidation, entering a repayment plan. So we'd start there if you don't know who your loan servicer is. The loan servicers that have changed, dealing with public service loan forgiveness specifically, this servicer named Mohila has taken over. Mohila is an acronym for, I won't say the whole thing out loud. They're servicing now loans for millions of borrowers, and they took over for Fed Loans, who exited the PSLF servicing game. We've seen that they've been doing a really good job with the administration of and recording of PSLF progress, payments, and all of that. But again, if you don't know who your servicer is, or you're having an issue with that, you can go to studentaid.gov and make necessary changes. Don't let that be the reason that you don't go into repayment in the right repayment plan for you. There are also calculators at studentaid.gov that can help you out, but you want to quickly try to identify who your loan servicer is.
Yeah,
and there you go. You got it posted there, studentaid.gov.
Yeah, that's the link, by the way. You're going to go to studentaid.gov/loan -simulator. And it starts out by, it's a great little tool. It asks you different questions, sort of, or if you're looking for repayment plans, or you're worried you're not going to be able to afford your payments. And then it just kind of collects some information from you, your income, your loan amount, all that kind of stuff, and will help you see what some of your options are. And then you, of course, want to follow up with your student loan servicer. But it's a great way to kind of just dive in and start seeing really that the landscape has changed, that there are some options that really can help a lot of people.
Heather, on that note, if you choose a repayment plan, either because you heard SAVE is the right idea and you need payment relief and you want to do an income-driven plan, you can also enter the income-driven repayment plan right at studentaid.gov. They have, if you look at the loan repayment section there, and drop down to the income-driven repayment plan selection. Actually, you can just do studentaid.gov/IDR and say, I'm entering one for the first time, or I want to change my repayment plan because we just heard on Smart Sense that I should be in SAVE. And the application has just been improved pretty dramatically in terms of the process. So they'll go get your previous year's IRS tax return, and they'll show you your payment based on your previous year's tax return in relatively short order. And then they'll enroll you in that SAVE plan. Another benefit of SAVE that I didn't mention before, and again, I'm not selling this thing. It really is the best repayment plan for folks. Anytime your monthly payment doesn't cover all of your outstanding interest, let's say you have $50,000 of student loan debt, and at a 6% interest rate, you're talking about $3,000 a year of interest. And let's say based on your income, your SAVE plan only requires that you pay $100 per month. So you're paying $1,200 in the course of a year, and you have $3,000 of interest outstanding accruing. So that difference is upside down. I'm doing quick math in my head here, $1,800. Zero of that accrues. Your balance does not go up in Save. No other repayment plan offers that sort of stopping of the bleeding of accrued interest moving forward, no matter what your payment is, even if it's as low as zero. So particularly for those interested in, longer term loan forgiveness, but that want to not have their balance increase over time. Save is also the right plan. So you can enter that right at studentaid.gov. Then your servicer is going to take over communicating with you on the payment part from there.
And that's huge, not having it accrue and get bigger, because that's been the problem for so many people. Is the balance just keeps getting bigger.
No more ballooning of rates. So no more ballooning of the balance now through this new Save plan as well.
Yeah. Another program that I think sounds like it could really help a lot of people is the Fresh Start program for people that are already in default. Can you talk about that, and also the on-ramping? What you might be able to tell us about the on-ramp process over the next year?
Great question. And yes, the Fresh Start program allows everyone that was in a default status within 1 year from when repayment resumes to fix your status ultimately and have it not go against your credit score and all of the benefits of not having a status of default. So you're automatically enrolled in Fresh Start for a year. All borrowers in default have a full year to figure out, be in the right repayment plan. If you're not working or you have a limited amount of income, you can enroll in Save, and that will keep you with as little as a zero payment in compliance with your repayment plan, even though you have a zero payment years into the future, depending on what your economic status, is, or your debt to income ratio is. The on-ramp is something different. It's similar to Fresh Start, where maybe you're not in default, but you fear you might go into default because now payments are starting again and you're in a tough economic situation. The on-ramp period, as you mentioned, just means that for the next year, so starting September 1st, payments are going to be required again. But for the next year, if you miss a payment, you're not going to be dinged for that. You're not going to go into any sort of defaulted status. Your credit won't be impacted. This is not a message for everyone to not pay over the next 12 months, because one thing that does happen on September 1st that is not reversible is the fact that interest starts accruing. And so your balance can go up. The Save plan can save you from that. This on-ramp period, if you're not making payments that are required of you, you're not going to be punished for it. You won't go into default for 12 months. However, none of that time counts towards income-driven repayment plan loan forgiveness or public service loan forgiveness. So it would really behoove you to figure out, can you make one of these income-driven repayment plans work? It would probably, I don't see why Save wouldn't be the best option for you, so that you're stopping the bleeding of accrued interest and try to make the minimal payment possible.
Okay, great.
Try to whatever the payment required is.
Yeah. Let's talk about the timeline, because you mentioned, so September 1st, the interest starts accruing, but that doesn't mean that your first payment's due September 1st. So can you talk about the timeline of what people can expect and how to start maybe preparing?
Absolutely. Great questions. And, we're almost there. The on-ramp is a helpful relief option. Again, much like I call forbearance the F word, because you're not getting any of the forgiveness benefits, and interest can accrue against you. It would behoove you to enroll in a formal repayment plan. And ideally, if you're economically, struggling, that payment could still be as low as zero. Interest is going to start accruing September 1st. Most of the services aren't getting their act together, or won't be billing you for your first monthly payment until likely October. Some servicers, I know Navient has already done this. They've already reached out to say, hey, we're not going to be billing you in September, but interest does start to accrue. And so if you want to make a voluntary payment, go ahead and do so, but we're not going to be billing you in September. Not making that voluntary payment would mean that your interest does accrue for a month. It won't ever capitalize, meaning That's when interest gets added to interest and you get a larger principal balance. But to avoid that month of accrued interest, two ways to do that: make the voluntary payment, or enroll in save, where you won't have interest accruing outstanding against you anyway. It's my understanding, and I would imagine that they wouldn't punish borrowers like this. There hasn't been an exact confirmation of that answer. If you enroll in save and your payment is not made in September, would they accrue that interest against you? I can't imagine if you enroll in save. If your payment's zero, obviously it won't accrue against you. But if you miss a small payment, it's possible that interest accrues, in which case you want to deal with that if you didn't make the voluntary payment. But save should be, that the income-driven repayment plan, save should be stopping that bleeding of accrued interest right out of the gate.
Okay. And then if you can, to talk about a couple of things that could be good if you're working with your employer, that your employer can pay towards your student loan, or they can pay towards your retirement if you're busy paying for your student loan. Those are a couple of options out there, right?
Two bits of recent legislation. And yeah, I mean, hopefully if employers are offering this kind of student loan benefit, they're reaching out to you and proactively offering this, particularly with the second one that I'll mention. That is they've already budgeted for it. And it's not every borrower can afford to do the contributions that would drive the benefit. But I'll talk about that one in a moment. The legislation that was passed a couple of years ago with CARES was that employers are able to contribute up to $5,250 a year towards your student loan debt if you're an employee, and it's not taxable to you. So that, much like your, say, medical insurance benefits, you're not taxed on that as a benefit. A lot of employers, I think the stats were 18% of employers were offering this, some kind of student loan benefit. This was in 2021, and another 30% were considering it. Obviously, they weren't doing it while they're not going to give student loan relief while the government's already giving it through the CARES Act. So now we've seen a lot of talking to a lot of employers who want to enroll in this kind of benefit. So know that if your employer there are certain rules to it. You can't discriminate in favor of highly compensated employees. So it depends on the plan that the employer puts together. But likely, if you're getting loan repayment in the form of a monthly contribution, it's not going to be taxable to you up to $5,250 a year. So that's a great benefit, and it's driving more employers to offer this to their staff as a recruiting and retention tool. Yep.
Yeah,
so great question, Heather. Now the other one is
ask for it when you're interviewing for a job.
I was going to say, that is there. I have a lot of statistics on the impact on recruiting and retention when employers offer a student loan benefit, and they're substantial. And there's still, particularly in certain industries, so this sort of great resignation or a difficulty, particularly in public service jobs, where it is difficult to retain staff, and so it definitely moves the needle. The other one is Secure 2.0. If you've heard of this legislation, it covers a lot of different benefits. It's broader legislation, but the one that impacts student loans specifically is if you are a student loan borrower who now has to make student loan payments here again in September or October, and this is keeping you from contributing to your 401k, and your employer matches contributions, you're missing out on sort of this free money, right? If you're not making a 401k contribution because you've got to pay your student loans, the employer can't make a contribution for you unless you make a contribution for them to match. So Secure 2.0 allows a verification process that says if an employee is making a student loan payment of, say, $400 per month, the employer can use that student loan payment verification to then they'll be the sole contributor to the 401k or the 403b for the employee. So that is free money that everyone should be taking whenever they can. So if your employer is matching contributions now, ask about Secure 2.0. All employers should have a vendor or an ability to access the verification process to be able to facilitate that for you. But so many borrowers have left that money on the table. I think the statistics around, we were talking in the hospitals mostly, but like 30% of staff don't make contributions to a 401k, even if it's whatever small amount a month that you can make. You're giving up free money by not doing that. And now if you're making student loan payments, that can be the driver for 401k contributions that otherwise wouldn't be going in there. So love that legislation, a creative and really helpful solution.
Yeah, I think so too. And it sounds like there are a lot of really good new options for people. And Jason, I know I've grilled you about a million topics in the last 30 minutes. So I want to thank you so much for sharing all of your expertise on all of this. And just real quick, for people who kind of just need to find information, where to start, where should people go?
Studentaid.gov. That loan simulator is a great tool. Again, I like this discussion that we morphed into talking about employers and how employers are helping. I think if you're, talk to your HR about what options are available for student loan help as this legislation has evolved. We know that employers want to get involved in helping staff. So you might find more help from your employer than has been available in the past. But studentaid.gov, obviously a plug for myself, Benelevate. We have a lot of information for both borrowers and employers as well, and can facilitate a lot of this. So certainly happy to serve as a resource as always for you, Heather. And as the servicers and student aid have stepped up their game in recent years in terms of servicing and options for relief. I know we didn't see the Supreme Court broad cancellation that looks to be a challenge to pass. The more you do your homework on other relief options, the more you see that there's a lot available. And so, just keep at it. And I appreciate you having me on, Heather.
Oh, thank you so much. Really appreciate you taking the time to talk with us today. And I know you helped point a lot of people in the right direction and giving them some new hope about getting through all of this debt. So thank you so much, Jason.
Great. Talk to you later, Heather. Bye-bye.
And thank you so much for being with us today. Hope that we answered a lot of questions for you. Again, just go to studentaid.gov. That new loan simulator will really help you out, help answer some questions, point you in the right direction, and make sure you're making contact with what might be a new loan servicer for you. And hopefully that will help you move forward in a way that will make things a little bit easier, because like I said, I know budgets are so tight right now. So good luck with that. Keep sending me any questions you want us to answer here and topics you want us to cover here on Sullivan Smart Sense, and we'll see you next time.